While government has been hitting out at ratings agencies for not upgrading India's credit rating despite its commitment to fiscal consolidation. In fact, remember the economic survey tabled before the budget mounted a scathing attack accusing rating agencies of being benevolent with China but ignoring India. However, things are unlikely to change, at least in the short term, because CNBC TV18 spoke with two major rating agencies, S&P and Moody's, and the message is pretty clear. Bring the deficit to 3% and then we can talk about an upgrade. Take a listen.
For a start, it's very important that we see policy anchors like this to guide fiscal consolidation going forward. But the test is often in its implementation, and it'll be very important for us to see the government moving along this path that it's outlined in this budget, such that over the next few years, if we start seeing meaningful fiscal consolidation, such that the fiscal deficits come down lower than what they currently are, and the debt stock continues to move lower, then, you know, as we've been saying publicly, this is something that could lend some upside to the ratings, assuming everything else remains equal.
What's very important to us in the medium term is to see the fiscal deficit path that is consistent with reduction of the debt to GDP ratio over time. And again, this did fall into a medium-term fiscal framework that is attempting to reduce that burden to 60% by 2023, along with reforms that would help strengthen the macro framework and institutional framework and contribute to growth.